So hi, Owen and Kate. This is the next question. I'm new to shares and looking to invest for both the medium and long term. Long term would be super/property and over time progressively more shares. In the medium term is for my kids, $110,000. I think that maybe is for their education. I have 20K now and want to add 30K from an offset account now and then continue to add appropriate amounts regularly. It should force the required saving with some return while allowing liquidity to be used as needed over the 2024 to 2033 period. So that must be when the kids are going through school. Can you explain what needs to be considered when investing using debt? And also when investing for medium term where funds will likely be needed regularly? Kate, you go first.
Yeah. So I think it's a good thing that you've really articulated your goals and time frame, because that's an important step when we're trying to figure out how we want to invest and if we want to be a high risk or a balanced investor. Knowing your time frame and your goals of what you actually want to use that money for is really important. And so if you're needing the money over the next decade, it's a little bit more of an interesting scenario because you'll need some of the money in the next few years and some of the money you won't need for 10 plus years. Yep. And so that changes your risk profile a little bit because there's some of the money you're going to need immediately. And we generally say if you need the money in the next couple of years, you shouldn't be investing it. Yep. But you've also some of the money you're not going to need for 10 years. So that might mean you still invest, but you invest in a different risk profile. So I might not go out and invest in a high growth portfolio. I might look something a bit more balanced and maybe make sure you've got the cash you need for the next couple of years, and maybe you invest the slightly longer term funds.
That's exactly what I was going to say. So in this instance, if the education expenses are in the next couple of years, that money should be in cash. So savings account, if you have a mortgage already, an offset account, and you should just be keeping the money there. That's the best place to keep that. And then outside of that, you would probably have a pretty aggressive investment allocation. So you'd probably have I don't know, say 90-10, as in 90% of the rest of the money is long-term, like shares, and 10% is like bonds or something safer like that. That's a 90-10 portfolio. But that won't need to kick in for a few years. And then basically what you want to do is you just want to keep a buffer of, a few years ahead of you where the money kind of trickles back into the offset account or whatever you're using as like your liquidity thing. For using debt, the only type of debt that I think should be recommended by like a financial planner or whatever is basically a line of credit on a mortgage, so on a house. So basically the way it works is if you have, say, $1 million property for round figures and you've got $500,000 paid off already, like this is just strictly hypothetical, most banks lend you up to 80%. That's why you have a 20% deposit, so 80%. So that means there'd be $300,000, the difference between your loan and what you could borrow, to redraw. And then you could use that as a line of credit to go and invest in something else, basically. If you use a line of credit, a proper line of credit, an accountant and like a mortgage broker or someone like that will help you set one of these up. It's actually good because then you can use a loan to buy shares. But most of the smaller amounts of money are things like margin loans, personal loans, or just weird types of investment loans that are just not feasible for most people because they're actually very risky. Because if the shares fall, there's typically rules built into them that you have to sell the shares and you have to give your money back. And that's typically when you don't want to sell. So I would say it's a pretty risky thing to do for most people unless you have some sort of secure asset. Because if you just think about it like this, the interest rates on a mortgage are very low versus the interest rates on one of these loans that brokers provide or whatever. They're crazy. Warren Buffett says, what did he say? He says something like, smart investors don't need debt, and if you're not a smart investor, you shouldn't even think about it, or something like that. It's something like he turns the logic around, and basically it's that if you're smart with your money, you don't need to use a loan to invest well, and if you're not going to be smart with your money, well, there's other things to worry about.
You can Google stories of people that have been margin called in 08, 09 and other unfortunate times.
Yep,
and they've had their whole portfolio kind of sold out from underneath them.